Previously.
When I first joined the insurance industry, right, I've been taking a lot of mian every day.
Mian? What kind of mian? Golong mian? Tatsu mian? Mian lah. Only the rich people can afford.
The rich don't need insurance, and the poor can't afford. Then who needs insurance?
Hi guys, for those of you who don't know us, my name is Noel and this is Marissa,
Hello.
and we are from GE Professionals and Financial Concept Consultancy. How much life insurance do you actually need? The amount to be covered for life insurance may not be that straightforward, as it will be based on individual financial situations, such as needs, but it may also be based on wants. There are basically 4 approaches in analyzing the amount of insurance protection. Number 1, rule of thumb, 10 to 20 years of your salary. Number 2, income replacement, years to support until the child's independent age. Number 3, human life value, years towards your retirement age. Number 4, total needs, cash needs and income needs.
One of the methods to analyze life insurance needs is by using the common rule of thumb. The common rule of thumb is the simplest method. It is 10 times of your annual income. This method is not 100% accurate, but it serves as a basis of the amount you need in case you do not wish to go into details of financial needs analysis, which we reckon is essential at the time of need, such as the premature death of a breadwinner. This ratio cannot be applied to every individual since age is a factor here. Someone that is 28 years old with kids and getting their life off the ground is going to need a lot more life insurance than someone who is 50 years old without a family. If you do not have an income or a spouse with no income, you may use minimum 5 times of your annual income. What this ratio really says is, if you make 100,000 in a year, you should have a 1 million life insurance policy for yourself. The same method applies if you are insuring your income due to disability or suffering from critical illness, which prevents you from earning a living. In this case, you are physically alive but financially you are dead. There are 3 ways to find out how much you must be insured for. The first one would be 5 to 10 times of your annual income, followed by amount of debts that you must settle, such as housing loan, credit card bills, personal loan, and etc. Last but not least, you may also consider the amount for long-term health care as a form of disability income, which may be up to 75% of your last drawn income.
Let's take a look at the hypothesis. Number 1, 5 to 10 times of your annual income. 2, amount of debts you must settle. For critical illness protection, you need to take into consideration the amount of debt you have and 5 to 10 years of your annual income. For example, your annual income is 100,000, your housing loan debt is 500,000. So, the total amount that you should be insured is 500,000 plus 500,000, which equals to 1 million. Number 3, as for the amount for long-term health care as a form of disability income, you may consider between 50% to 75% of your last drawn income, as the debts may be settled, but you may require quality health care and nursing care, which may be expensive as well. For example, your annual income is 100,000. Your desirable income replacement is 75%. So the total amount that should be insured is 100,000 times 75% equals to 75,000, which also equals to 1 million coverage.
Moving on to the second approach, we shall look at income replacement approach, IRA, which is the number of years to support your children or siblings till their independent age. For example, Mr. Financial Freedom has an annual income of 100,000. 70% of income is required to support or maintain his current living standard. The age of his child is 1, and the number of years to support till the child's independent age is 23 years. So, using the IRA method, which is 70% times 100,000 times 23 years equals to amount of 1,160,000. Now, moving on to the third approach, which is the human life value, years to retirement age. For example, Mr. Financial Freedom has an annual income of 100,000 and he is now age 30. The retirement age is 60. Thus, years to retirement is 30 years. Using the HLV method, 100,000 times 30 years equals to 3 million. The amount seems huge and not really appropriate as a form of income replacement, but it serves as a form of possible future income losses.
Thank you guys for watching and supporting our videos. We really appreciate your feedback, and if you have any questions or would like to know more in detail, you can drop us a comment down below or you can message us. That's all for now. Bye!
Bye!